When you're thinking about the transition to the green economy, the role of bond investors is absolutely critical. Can't do it without them. So I think you should really see this almost as something of an ESG bond revolution.
We think ESG label bonds will become to fixed income what electric vehicles are to the automotive industry. The IF report has taught us the importance of ESG label bonds within the fixed income market, its relevance for corporates and sovereigns in the future.
Think about ESG bond markets. At the moment, they're quite niche, they're quite small, only a little over $1 trillion in size. But by 2030, we expect those to reach around $35 trillion, and by 2050, over $60 trillion.
We expect that allocation to ESG label bonds will continue increasing, and new issuance is expected to surpass $1 trillion in 2022. That is over a 50% increase year over year.
With a growing number of large companies and asset managers committing to reduce net carbon emissions, we believe demand for green bond financing is set to increase substantially over the next several years.
We're seeing exponential growth in ESG-labeled bond markets, mainly in mature markets, but also, I think, in different types of instruments.
I would differentiate ESG label bonds mainly in two ways. The first one being specific use of proceeds bonds, led by green, social, and sustainability bonds. The second category would be key performance indicators linked bonds, led by sustainability linked bonds.
Investors in green bonds are looking for how their proceeds have been used. Are they going toward renewables, green projects, or projects that otherwise benefit climate and the environment? That's one segment. Another area that's really gaining in popularity is sustainability-linked bonds. And instead of use of proceeds, those have what you call key performance indicators, or KPIs, that they have to live up to.
It's very early days as far as this asset class goes. Of course, it has its teething problems like any new assets, a lack of reliable and comparable ESG data and benchmarks, slow progress in the development of global taxonomy and disclosure regimes. We have a lack of transparency about ESG scores and ratings, and liquidity is still a challenge for this sector of the fixed income markets, even though it is set to improve over time.
It's investor behavior with green bonds that actually tends to limit liquidity in the market a bit, because many of the big investors in green and ESG bonds take it on a buy-to-hold basis. So they buy the bonds, they put them in the portfolio, they hold them to maturity. And over time that will change. As these markets build out, it will enable the kind of short-term, medium-term, long-term trading strategies that characterize mainstream fixed income markets. In a few years' time, there aren't going to be any global investors who don't have a significant allocation to ESG and green investments. And if you look ahead further to 2050, when everybody is going to be delivering on net zero commitments, really we will have effectively greened global bond markets, and the world will be an entirely different and better place.